Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
What's up, everybody? It's time for another Mebisode. Did you know it's been 15 years since I put out my first book, The Ivy Portfolio? Subtitle of the book was How to Invest Like the Top Endowments and Avoid Bear Markets. It was published in 2009, right in the middle of a bear market. But it looked at some of the top endowments like Yale and Harvard, how you could try to replicate their incredible track records over the past few decades, but also some other ideas. We looked at tactical and trend following overlays. We looked at mean reversion systems, like what to do after a really bad month in markets or number of down years in a row. We looked at alts and things like listed hedge funds. We looked at other topics like how to clone the top hedge funds through 13F filings and Warren Buffett's stock picks. Anyway, I think the book's held up really nicely over the years. A fun side story. When the cover originally was proposed to us by Wiley, I said, ugh, this is terrible. I held my own contest, had a bunch of design decisions, and said, but you know what? I don't know that I have great taste. We'll let the audience decide. And the cover I liked got about 5% of the vote. And the cover that's now the cover, of course, was Wiley's choice and got the majority of the vote. So what do I know? Anyway, we wrote a new paper, trying to walk forward 15 years, trying to look at some of the lessons learned from that period as well as market sense. It's titled, Can We All Invest Like Yale? So enjoy this new Mebisode. David Swensen is regarded as one of the greatest capital allocators of all time, if not the greatest. He's got my vote, by the way. Before his passing in 2021, Swensen's tenure at the Yale University Endowment Office was legendary. The endowment returned over 13% per annum, higher than any relevant benchmark, including the unstoppable U.S. stock market, and with lower volatility too. Swensen's massive success led many investors to attempt to adopt the endowment style of investing, or more specifically, the Yale model. What does that phrase mean? I wrote about this in my first book, The Ivy Portfolio, and attempted to answer this very question. 15 years have passed since the book's publication. What's changed in markets, and what's stayed the same? Here, we look at the endowment model, its main features, and if we can, in fact, invest like Yale. Here's a quote from Swensen. 3 basic investment principles inform asset allocation decisions in well-constructed portfolios. First, long-term investors build portfolios with a pronounced equity bias. Second, careful investors fashion portfolios with substantial diversification. Third, sensible investors create portfolios with concern for tax considerations. The principles of equity orientation, diversification, and tax sensitivity find support both in common sense and academic theory. End of quote. University endowments, they have a few advantages over normal investors. First, they don't pay taxes. Wouldn't that be nice? Second, their time horizon extends beyond our own lifetimes. Typically, an endowment's primary goal is to outpace inflation with additional returns to ensure both sustainable spending and long-term growth of the endowment. Since endowments can take the long-term view regarding portfolio design, this feature has resulted in what most consider to be the defining characteristic of the endowment model, a focus on equity and equity-like investments. A secondary feature is a focus on active management where appropriate. Alternatives, what everyone loves to call alts, have historically played a huge role in these portfolios. And the most recent Yale endowment target asset allocation included a whopping 60% allocation across absolute return, which is hedge funds, leveraged buyouts, which are private equity, and venture capital. The lines have blurred over the years between definitions of active and passive, and public and private, and what is or isn't an alt, but it's clear the endowment is not market cap weight indexing their entire portfolio. So what does the endowment allocation look like today? According to a recent endowment update in 2020, Yale had allocated to absolute return at, and I'm going to round these, 22%, domestic stocks, 2%, foreign stocks, 11%, leveraged buyouts, 16%, natural resources, 4%, real estate 9%, venture capital 23%, and cash and fixed income up at 14%. Some readers may jump out of their chair and exclaim, they only have 2% in U.S. stocks? However, the broad categories of private equity and venture capital give similar exposure to the U.S. stock market, just in a different way. If you exclude absolute return and group the private equity and VC allocations into the equity bucket, and then you go and normalize the allocations, the ballpark Yale allocation from my old book rounded out to 50% stocks, 15% fixed income, and 35% real assets. Now, to be clear, there's some assets like TIPS, which could be considered quasi-fixed income. We put them in the real asset bucket. There's another asset like corporate bonds, which Swenson hated, that you could argue, are they stock-like? Are they bond-like? On and on. But we're trying to just simplify here. And we simplified this even further in a portfolio we dubbed the Ivy portfolio to just 20% each in U.S. stocks, foreign stocks, U.S. bonds, REITs, and commodities. Then you had Swenson himself. He recommended an allocation for individuals in his 2005 book, Unconventional Success, which was 20% U.S. stocks, 20% foreign stocks, 10% emerging market stocks, 20% REITs, 15% U.S. bonds, and 15% TIPS. Might the Ivy portfolio and Swenson's individual portfolio hold up against the Yale endowment and other relevant benchmarks over the years? Can any of us really invest like Yale? Let's begin by examining the returns of the Yale endowment over the past 40 years to establish our baseline. For some broad context, we'll compare the returns to the average endowment. We'll also include traditional benchmarks like 60-40 allocation, which is 60% U.S. stocks, 40% U.S. bonds, as well as something like the S&P 500 for broad U.S. market exposure. As a reminder, most of these institutions report returns ending in June 30th fiscal year, so they're not calendar years. And we're going to look at 1985 through the summer of 2024. All these charts can be found in more detail on our website, either at Meb Faber or CamryInvestments.com. If you want to look at all the visuals to download this white paper, we'll also put it in the show notes. But here you have, and I'll simplify, the average endowment did 8.8%. Pretty good. Yale, however, did 13.2%. So significantly better. 60-40 came in the middle, around 10%. And S&P did 11.9%. Volatility was reasonable for all. Average endowment was around 10%. Yale was 12%, 60-40, 10%. And then S&P, of course, just being stocks, up around 15%. Sharp ratios, average endowment 0.56, Yale up at 0.8, and then 60-40, 0.66, and S&P at 0.55. If you look at the worst year for most of these, it was usually around 20%. So the average endowment minus 18, Yale minus 24, 60-40 at minus 13, and the S&P at minus 26. Now, there's an important note here in that if you only look at drawdowns once a year, then you can only tell at that sort of time frame. So those worst years probably understate the drawdown by 2x. We'll get to that more later. On first pass, it's clear there may have been something special in the water up in New Haven. You had higher returns, higher Sharpe ratios, reasonable volatility, all point to Yale's exemplary track record. They returned over 3 percentage points above a 60-40 allocation. The average endowment is basically a 60-40 portfolio, but historically has been slightly worse across all metrics. All these strategies have good returns. Yale's performance just happens to be great. But 40 years is a long time. What if we examine the more recent past? And here we have the SPY in the room. Many endowments famously struggled in the 2008-2009 bear market and global financial crisis. Liquidity seized up, and these aggressive allocations resulted in the worst year ever for these strategies. As a reminder, these endowments and many other institutional pools of capital report returns on a fiscal year ending June 30th and only once a year. Subsequently, the maximum drawdown from many of these strategies intra-year was likely 2 times larger than the worst year to statistic. A benefit of only peaking once a year, of course. It's hard to know how much illiquid alternatives benefit from smooth returns, a practice that drives many investors like Cliff Asness crazy. He's labeled the practice volatility laundering. If an unscrupulous manager claims much lower volatility than reality, we would all like to allocate to equities at 4% vol, right? Anyway, if you narrow the analysis to the last 15 years, nothing comes close to U.S. stocks. We talked about their historic run in a recent piece called The Bear Market and Diversification. Humorously, of course, stocks have appreciated another 25% since I wrote that. The massive outperformance of U.S. stocks even pulled the 60-40 portfolio up as well. We'll look at the returns here. So 2010 to 2024, average endowment, and I'm going to round these again, 8%. Yale did 11, so significant outperformance again. 60/40 did 10, and S&P did 15. So S&P stomped everyone, of course. Volatility is what you expect. But what I want to point out here, when you look at the Sharpe ratios, and this is why it can be misleading if you're looking at, say you bought a hedge fund, you buy an investing strategy. Well, the average endowment 0.73, pretty good. Yale 0.96, almost 1. 60/40 at 1.25. So let that sink in. S&P over 1. If you saw this track record as a hedge fund, you say, oh my gosh, let's pay these guys 2 and 20. This is amazing. Turns out it's just passive market cap beta, but it's been exceptional the past 15 years. Now, to be fair to Yale, if you examine 25 years from 1985 to 2009, Yale again looks exceptional, and the average endowment, well, still pretty average. This is the challenge, of course, of picking a particular time window for analysis. Given the various time frames chosen, you could come to totally different conclusions. Innes and others have demonstrated that they call the 1994 to 2000 period the golden age for endowments, while other periods didn't look as rosy. If you zoom out a bit, we can make some broad generalizations, one of which is the average endowment is pretty average. That's nothing to be ashamed of, however. If you compound around 9% per year for 40 years, that's still really impressive. It seems less impressive than anyone who just bought 60/40, forgot about it, went to sleep, and then ended up in the same place. But many assume that the world's largest and most connected institutions would be able to leverage resources to produce strong returns and outperformance. And historically, that just hasn't been the case. This average performance isn't limited to the endowments. We've written articles comparing giant investment organizations like CalPERS and Bridgewater and found that most would be simply better off buying some ETFs, firing everyone, calling it a day. One of the performance drags for all investors, professional and individual retail alike, is fees. Innes estimates that the endowments allocating to alts generate total operating costs of at least 3% per year and calls it an impossible burden. While the average endowment has been average, we can also generalize that Yale has been pretty darn special over time. So what's the deal? And again, whatever the deal is, can we replicate it ourselves? The Yale endowment has done an excellent job investing over the past 4 decades. Do they have the magical formula, or is it possible for the public market investor to achieve anything near Swenson's returns? Could we buy some ETFs that achieve anything like this historical track record? Most investors don't have access to the velvet rope alternative funds that Yale and others do. So where to even begin? A good starting point would be Swenson himself. We can use Swenson's recommended allocation for individuals as our guide. As a reminder, that's 20% US stocks, 20% foreign stocks, 10% emerging market stocks, 20% REITs, 15% US bonds, and 15% TIPS. We'll add this portfolio to our table labeled Swenson, see how it performed over the last 40 years. So I'll summarize, but it turns out it's not bad. The portfolio performed in line with other benchmarks like 60/40 and the average endowment. We found that most buy and hold global asset allocation portfolios performed similarly in our book, Global Asset Allocation. And if you added columns for the global market portfolio or former Harvard endowment head L. Arian's recommended portfolio, they would all be similar, which is to say, good. But that's not the question we're asking. We're asking, how do we look more like Yale? So first of all, we all know Yale targets active management where appropriate. Our buddy and podcast alum Peter Mladina found you could replicate much of what Yale did with factor exposure and some leverage. He also found they were pretty good at private equity and VC too. What if we decided to apply factor exposures to the stocks portion of the Swenson portfolio? We'll use traditional factors like shareholder yield, value, momentum. Is this cheating by using hindsight bias? Of course it is. We also need to acknowledge much of Swenson and his manager's brilliance was incorporating many of these concepts at the time. It's one thing to implement these ideas today. It's another to do it back in the 1980s and 90s. And don't forget, the Yale endowment allocation hasn't been static like the portfolios that we're looking at, but rather morphed and changed over the years. It would likewise have been impossible to implement many of these strategies decades ago, and we're presenting returns without the drag of manager fees, while low today, they would not have been 30 years ago. Anyway, with all this in mind, how do these factor bets play out? Historically, they would add a little over 1 percentage point in returns to the overall portfolio. We call it Swenson Plus in the table. Good, again, not quite there. One of the potential benefits of using active management and getting exposure to certain asset classes like private equity is you get some leverage, explicitly or implicitly. So what if we decided to lever the entire portfolio? As noted a moment ago, Peter Medina found the leverage was part of the key to replicating much of Yale's active equity management returns. Might we have similar success applying leverage across the entire allocation? Dialing up the leverage increases overall returns in line with Yale. Now, to be fair, you see a pickup in volatility and a subsequent loss in Sharpe ratio, so the portfolio would not be for the faint of heart. However, most endowments have an unlimited time horizon, so for those trying to look and be like Yale, it could be a possible solution. Observers will also note you could probably leverage the 60-40 portfolio and end up in a similar place, and they'd be right. Now, we get quite nervous making this analogy at this point in time with U.S. stock valuations at near or record levels, but as mentioned previously, I would have said that last year too. So if you look at the returns going back to 1985 to 2024, if you have the average endowment around 9%, Yale at 13%, 60-40 at 10, S&P at 12, by using this Swensen factor tilts and leverage, you get up to 14%. Now the volatility is up around 18%. For Sharpe ratio isn't magical. It's around 0.6, and you got to suffer through a worst year of about 30%, but you still end up at that 14 compound returns if you're looking at long-term horizons. People love to say, what could be some further extensions? You guys know I've been a long-term proponent of trend following strategies to complement a traditional buy and hold portfolio. If you utilized a 30% allocation to trend out of the 150% and normalized everything else, you would have generated similar returns to the leveraged portfolio, but with reduced volatility and drawdowns. We don't know many endowments incorporating much in the way of trend or managed futures, however. The paper gets into a lot more of the specifics, by the way. And there's equity curves. As investors review the tables, charts in this paper and Mebisode, many will come to varied and quite possible opposite conclusions. As the old Wall Street adage says, that's what makes a market. Some investors will read this paper, listen to this episode, conclude the best way is just to invest, is just buy U.S. stocks, call it a day. Others see the historically strong returns of a U.S. 60-40 portfolio, they stop there. Now, there's some adventurous investors will follow the path of Swensen and diversify globally and even add some real assets like REITs and TIPS. Some may index the public portfolio and then go on an alpha search in private markets. Others, like us, will explore our leveraged factor and trend-based extensions of Swensen's core ideas. We are reminded of the quote from William Feather. One of the funny things about the stock market is that every time one person buys, another sells, and both think they are astute. We feel the same could be said for asset allocation portfolios too. So can we or can't we? The question remains, can any of us invest like Yale? As we have seen in real time, across many benchmarks as well as the average endowment, the answer is no. Even Swensen's own recommended allocation, while solid, did not match the lofty returns of the Yale endowment. However, by utilizing some widely available factor exposures and some leverage, a historical simulation gets pretty close. Will this approximation hold up in the future? Perhaps David Swensen was the N of one individual, and something really is just different in the water in New Haven. Only time will tell.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.
Cambria Investment Management LP, Cambria, is a registered investment advisor. The information set forth herein is for informational purposes only and does not constitute financial, investment, tax, or legal advice. Please see the appropriate professional advisor for advice specific to your situation. There is no guarantee that a particular investment strategy will be successful. Opinions expressed herein are subject to change at any time. Past performance does not guarantee future results. All investments are subject to risk, including the risk of loss of principal. The average endowment, Yale endowment, Swensen, Swensen Plus 150%, and Swensen Plus 150% trend portfolios presented in this paper are hypothetical. These portfolios were estimated based on publicly available information about their broad allocations. However, the specific underlying assets used in the actual allocations were not disclosed or were not established in the case a theoretical allocation was proposed. To construct the portfolios for this study, proxies were selected based on a reasonable assessment of what likely represents the intended exposures. Every effort was made to construct our portfolios in a manner that reasonably reflects the intended allocations based on available information. But investors should be aware that these results are estimates and do not reflect the actual performance of any real-world portfolio. Hypothetical performance does not represent actual performance, was not achieved by any investor, and actual results may vary substantially. The assumptions and criteria underlying the hypothetical portfolios may introduce material differences from real-world performance. Additionally, hypothetical performance has inherent limitations, as it does not account for trading costs, bid-ask spreads, market impact, slippage, execution constraints, or changes in market conditions, all of which could significantly affect realized results over time. Use of third-party information. Certain information contained herein has been obtained from third-party sources, and such information has not been independently verified by Cambria. No representation, warranty, or undertaking, express or implied, is given to the accuracy or completeness of such information by Cambria or any other person. While such sources are believed to be reliable, Cambria does not assume any responsibility for the accuracy or completeness of such information. Cambria does not undertake any obligation to update the information contained herein as of any future date. Currentness. Except where otherwise indicated, the information contained in this presentation is based on matters as they exist as of the date of preparation of such material, and not as of the date of distribution or any future date. Recipients should not rely on this material in making any future investment decision. Past performance. There's no guarantee that the investment objectives will be achieved. Moreover, the past performance is not a guarantee or indicator of future results. Benchmarks. Any indices or other financial benchmarks shown are provided for illustrative purposes only, are unmanaged, reflect reinvestment of income and dividends, and do not reflect the impact of advisory fees. Investors cannot invest directly in an index. Comparisons to indexes have limitations because indexes have volatility and other material characteristics that may differ from a particular hedge fund. For example, a hedge fund may typically hold substantially fewer securities than are contained in an index. Forward-looking statements. Certain information contained herein constitutes forward-looking statements, which can be identified by the use of forward-looking terminology such as may, will, should, expect, anticipate, project, estimate, intend, continue, or believe, or the negatives thereof, and other variations thereon or comparable terminology. Due to various risks and uncertainties, actual events, results, or actual performance may differ materially from those reflected or contemplated in such forward-looking statements. Nothing contained herein may be relied upon as a guarantee, promise, assurance, or a representation as to the future. Registration status. SEC registration does not imply a certain level of skill or training. Definitions. The 60/40 portfolio referenced in this paper is represented by a 60% allocation to the S&P 500 and a 40% allocation to GFD indices, USA 10-year government bond total return index. S&P 500. The S&P 500 index is an index of 500 stocks chosen for market size, liquidity, and industry grouping, among other factors. The S&P 500 is designed to be a leading indicator of U.S. equities and meant to reflect the risk-return characteristics of the large-cap universe. GFD indices, USA 10-year government bond total return index. This index represents total returns of U.S. 10-year government bonds. Sources and notes related to GFD indices, USA 10-year government bond total return index. Sources: Sidney Homer, A History of Interest Rates, Princeton Rutgers, 1963, from Joseph G. Martin, Martin's Boston Stock Market, Boston, 1886, parentheses 1800 to 1862, end parentheses. Hunt's Merchants Magazine, 1843 to 1853. The Economist, 1854 to 1861. The Financial Review, 1862 to 1918. Federal Reserve Bank, National Monetary Statistics, New York, FRB, 1941, 1970, annually thereafter. And Solomon Brothers, Analytical Record of Yields and Yield Spreads, New York, Solomon Brothers, 1995. Notes. Current yields on the sixes of 1790 are used from 1800 through 1822. On the sixes of 1814 through 1827 are used from 1823 until 1829. And the fives of 1821 through 1835 are used from 1830 to 1834. The federal government completely paid off its debt in the 1830s, so the Boston City fives are used from 1835 through 1841. The sixes of 1842 through 1863 are used from 1841 through 1845, and the sixes of 1848 through 1868 from 1846 to 1862. Data are taken from Hunt's Merchants Magazine and are periodic with the previous month's quotation used where none is available for 1843, 1844, and 1846 through June 1848. Data are monthly from June 1848 through 1853 using NYSE quotations. Data for 1854 through 1857 are taken from The Economist with NYSE quotations used for 1854 and 1855, and London quotations for 1856 and 1857. The United States yield data are monthly from February 1862 until December 1933 and weekly thereafter. The annual data are taken from Joseph G. Martin, Martin's Boston Stock Market, Boston, 1886. From February 1862 until December 1887, the 6% U.S. government bonds of 1881 are used. From January 1878 until January 1895, the 4% U.S. government bonds of 1907 are used. And from February 1895 until September 1917, the 4% U.S. government bonds of 1925 are used. Where no trades were recorded during a given month, the previous month's yield was used. The source for this data is William B. Dana Co. The Financial Review, New York, William B. Dana Co., 1872 through 1921, which reprinted data published by the Commercial and Financial Chronicle. The 4% Liberty bonds are used from October 1917 through December 1918. And beginning in 1919, the Federal Reserve Board's 10 to 15-year Treasury bond index is used. 10-year bonds are used beginning in 1941.